There we go. Now we're recording. Welcome to Capital Markets Wrap, everybody that's trickling in so far. And we'll kind of give people a minute to fill in the room. But I want to say thank you very much to those that are attending. A big thank you to our sponsor, Poly. For those of you that are unfamiliar with all the cool stuff Poly's been doing lately, their term, not mine. They're revolutionizing mortgage capital markets. They actually have the industry's only vertically integrated capital markets solution, which provides value for the entire mortgage chain from rate lock through loan, sale, and delivery. I'd encourage you to check out their website at poly.io. As you can see, I am not Rob Chrisman. I'm Robbie Chrisman. I've been waiting all year for Amazon Prime deal day so that I can buy a razor. It's finally here. So we can get that 2 day shipping. Ira, I might send you one based on how you're looking, although you're more manicured than me. So my dad will hopefully be back next month. He had some travel plans rerouted due to Hurricane Milton. But as always, very pleased to be joined by our esteemed panelists. We have Mr. Rob Kessel, who many of you know from Compass, but now Rob is doing his own coaching thing for capital markets. He's created this university, which is pretty neat. And I would encourage people to certainly check that out. From Poly, we have Marcus Lam and the chief proprietor of Milnerisms himself. We have Ira Selwin from US Mortgage. I have to tell you, since the last time we spoke, I received a book of Milnerisms in the mail from Stephen Milner. So
Good.
I've been incorporating them in my everyday life. It's helpful. Old school mortgage banking philosophy
Yeah,
for the
it's good stuff.
new generation. Yeah. Well, let's get into it because much like my goal wasn't for me to host, it was for my dad to host. My goal is not to talk on this show much, so I'm going to try and get out of the way here. But we have several topics that I'd like to cover. We're going to talk loan amount limits, LPA choice, and these disasters we're seeing and their impact on businesses and the ability to close loans, and then kind of talk about overall hope in the industry. But kind of like I mentioned there, we'll start with loan amount limits. And Rob, I want to go to you first before we talk about the actual loan amount limit changes. Why do companies jump the gun on increasing their own loan limits? Is there a benefit to that? Can you provide some of the historical nature of loan limits, how you see them evolve, and why companies get ahead of the federal agencies?
Well, I mean, I think certainly not all of them are, and some of them are a little bit more ambitious in doing so, and maybe they've figured out the secret sauce to confidently pick the right numbers and not worry too much about picking too high of a number. But it's a tough market out there, and everyone's competing to get new business. And if there's something on the margin, or if they're the first to jump, or they have the highest loan limit, and they can differentiate themselves, I think that's one of the reasons that lead to it. What volume of production is actually on that? The edge is, I guess, debatable. I don't have those analytics, but probably more around marketing from my perspective. And certainly there's a little risk associated with it, as we know. But that'd be my take on it.
But so these companies essentially say, cool, we'll originate these loans before they're eligible for sale. And then at the moment they become eligible for sale, we have them on our books and we'll just package them off. Is that the thought behind it?
Yeah, that they're just kind of doing it within their workflow and the time it takes to close a loan and get it ready for sale, such that it coincides with when they become available, the higher loan limits.
Yeah. Well, Ira, this year we've seen companies getting an even earlier jump start on what they're calling advanced loan limits. All this stuff is kind of like, were we talking about get into spring before we're even midway into fall here? It's a little weird to me, but what are you seeing out there on the street when it comes to these advanced loan limits?
Yeah, so we had a couple companies come out, some of the big players in the industry jumped out a couple weeks ago with, loan limits in the low 800s. If we look back to 2020, 2021, 2022, I think it was a little more obvious, and I think people felt a little more comfortable rolling out these loan limits early. And they weren't even that early. It was maybe October, only a month. But, even last year, we saw a little bit of an advanced loan limit, and I was a little skeptical. They did come in, above what most people were projecting, but there's a little uncertainty this year with loan limits. You've been hearing about pockets of areas that have experienced, some dips in sales prices and things of that nature. So I'm actually very surprised that we started to see this in September out of all months before we even had the first month of data. So the loan limits are calculated based on Q3 year over year. We didn't even receive the first month of data when these were pushed out. So um, I guess some of it is, hopefully luck that they are calculating their loan limits right. But I guess the problem for, we're an IMB is some people are going to 795, some people are going to 800. So where do you really stick out in advance of these numbers actually being published? We're actually holding off a little bit. I'm trying to get some more information before, we roll out an advanced loan limit. We also didn't have too many loans that butted up against the limits in previous years, so it's maybe a little less urgency. But I think a lot of it, as Rob mentioned, is the marketing piece of it. Sort of just trying to get every loan you can right now.
Well, I'm hoping you can dive into that slightly before I go to Marcus here and talk about the calculations across mortgage companies. Yes, there's a marketing component. Maybe we're not originating it. It's kind of a time-old tale of the originators want something, but how much of it are we going to actually originate? You take us inside the calculations of these companies as they decide where to raise the loan limit, how soon, what kind of credit box they're providing, and the rationale.
Yeah, so we're seeing some of the big players, the Rockets and of those natures going up to, I believe it was 806 or 802. I forgot the number offhand. And I guess, their internal calculations figured that that Q3 year over year increase in prices was going to justify that 802 number. I think it was around 4.6 or 4.7%, if I remember correctly. And then you have a couple other, you know, lenders or investors that came in lower around the 795 limit. We actually had one investor, I'm not going to name them, but they have different limits for correspondent business versus broker TPO business, which I found very interesting. Us as an IMB, if we're closing loans, we have a lot of risk that if we close a loan now at a higher loan limit, and those loan limits ultimately come in lower, we are now forced to either, sell that loan, either keep it ourselves and portfolio it, even though we're not a bank, or maybe sell it scratch and dent at a reduced price, or maybe hopefully it fits a jumbo credit box where we could still sell it to a jumbo outlet. But right now, I think it's just a little too early to really execute on that. And I think it's a huge risk for some companies. All it takes is one or two loans to come in below those or above those limits, and you could be stuck with a couple loans with a couple $1 million.
Marcus, I do want to ask you about this from a tech vendor side of things, but before we get to that, kind of your preliminary thoughts here on companies jumping the gun earlier and earlier every year. You've been in this game a while now.
Yeah, I'm with Rob. I think it's more of a marketing play, just because if you look back at my past experience with this at my previous companies, the workflow always went the same route. Companies would announce it, then our LOs said we had to have it to compete. We would offer it as long as we had someone to sell it to. But realistically, if you think about I think even at the 802 loan amount, it's only a $36,000 increase. So it's a pretty narrow window to have a loan missed by just a few $1,000s. And then to Ira's point, if you misfire, that's your hole in the Death Star. I mean, that's a catastrophic error if you get that wrong. So I would say probably more of a marketing play, more so than anything. And you're right, if you rerun AUS once new loan limits are announced and the AUS is updated, and you get ineligible for something else, then you're suddenly stuck with a loan.
Go ahead.
I would say on the tech side, I mean, we'll accommodate, right? If someone wants to update their conforming loan limits ahead of time, we'll go ahead and get that programmed in there. But it's not really our decision to say yes or no, you shouldn't do this, or yes, you should do it. We'll follow the client's request.
Well, I was going to say, how do tech vendors incorporate this? But Poly is at the cutting edge of the game, so maybe you have capabilities of programming this in ways others don't. And I'll just assume that you don't need to elaborate on it. Rob, I want to go back to companies potentially being stuck with these loans. I would assume that means that you're forced to sell the loan at a discount or to scratch and dent. is there calculation that goes on here? We think we can get this many and even if the loan limit comes in below, we'll still make money in this advanced marketing play, or what's the calculus here for companies?
Well, I mean, I think you can, if I'm not mistaken, you can write that the lender could pay down the balance and still get it under the limit. So that's one avenue, right? Where if they were, $1,000, $2,000 over the limit, that I believe they can write down. And maybe you, Ira or Marcus, you can correct me, but I believe they could pay it down straight up and sell it as a conforming balance because the balance is below that limit. So that I believe remains an option. And then, to earlier comments, jumbo execution remains an option. The scratch and dent on that size of loan is such a draconian cost that I think, the lender would be working with the borrower on some alternative approach and scratch and dent. But I would defer to the others and maybe more practical experience in this kind of thing.
Yeah, Ira, or sorry, go ahead, Marcus.
I was going to say, I personally feel like they should just follow the government's take on this, and just like government loans haven't with an FHA case number, just have that for agency loans and make it clear cut. So there's less gamification, but that's my take. I wouldn't press that on everyone.
Ira, can we talk about the strategy of companies writing down loans by a couple $1,000s and sliding it into the government there?
Yeah, it's actually it's on my list to do some research on to how to cure if you haven't approved and eligible. My initial thoughts when I first started looking into this, that was not able to be done. But I'm not going to just shut the door on that. So I'm still doing a little bit of internal research on that piece to see again, if we're over by a couple thousand, do we write it off, principal reduction, write it down. So it's just something I haven't dug into yet.
Would you consider it, if I talk about our companies going too far, and that's the question, do you really feel like it's a case by case basis of companies understanding their book of business and saying, well, we have a lot of production here, so we should be able to, then how much does it vary company by company for these decisions?
Yeah, I think it's a little bit of a mixed bag, right? Some people just see it and they're like, okay, we got to get it out right away without doing any thought, any background thought on it. The way we looked at it was, again, even in previous years, we've done the same thing. We said, okay, we had how many loans that, came up where it would have been impacted. And, if it was a major impact, it would probably be a more pressing issue where we'd say, okay, we really need to exhaust all avenues for this because we're actually losing business. But for that small piece of business, especially as Marcus mentioned, it's not a huge loan amount. Change, we just don't feel comfortable with it right now. Now that could change in the month once we get more data, obviously. But I think it does depend on your book of business, especially in areas that may not have high balance available. If you have high balance available in an area, at least you can fall back on the loan either being a high balance or not a high balance. But I think it would be more of a pressing issue in areas that don't have high balance, such as most of Florida, as an example.
Be
Well, who
interesting
knows?
to an ex post analysis on if any of these guys got it wrong, whenever they release the numbers. And I'd probably bet on their numbers probably being pretty close to accurate, given the amount of bet that they're making and the size of production they're likely to experience. But it'll be interesting to do an ex post once the numbers come out.
Yeah.
On the large amounts of data front, we do have like batch API ability where you can run entire pipelines through a system just to figure out what actually is near that new high bal loan limit to maybe do a refi. So that's another option on the tech side of the house too.
A very good point. I think it flows well into our next subject here, and that's this LPA choice from Freddie Mac. And so I guess starting next week, this enhanced LPA or loan product advisor feedback messages will kind of give companies more opportunities to turn cautions to accepts. Ira, you had brought this up originally, this whole LPA choice thing. I think you're a little more well versed than I am. I can read some of your notes, but in general, can you explain the rationale behind this and what Freddie's hoping to accomplish?
Yeah, so I feel like this flew under the radar a little bit in the last few weeks with everything that's been going on in the market. But basically, Freddie Mac is providing a new release for LPA where certain files that do not receive an approve, that maybe receive a caution, it will actually guide you to how to change that caution to an accept. So for an example, if you get caution, it may tell you, hey, if you provide $10,000 in reserves, you may now see an accept. Now, back in the old days of DU and LP, you sort of knew the ways to, I don't want to say manipulate the data, but you knew ways to change those loans into an approval. And through the years, that's changed a little bit. It's sort of been more of a black box, and you don't know what exactly they're looking at. But it is interesting that they are looking to push more loans or give guidance, sort of opening up the box a little bit on what exactly they are looking for. So if it's, whether it's additional reserves or there's a couple other, different data points that they'll suggest. Maybe your LTV is at 95, now you're going to 94. So they're looking to obviously provide more feedback on how to get more borrowers approved. But it is kind of interesting, sort of opening up that box a little bit, right? In these days of AI and the talk of, bias in AI and what exactly is AI looking at, it's sort of um, an interesting rollout that they're doing.
Well, as a quick follow-up, is it fair play in your mind, good on them for giving us an opportunity, or is it, hey, this is going to be something that could lead to unintended consequences?
I think you're going to have to prove the data anyway. So if they're asking for, you need $10,000 in reserves, you're going to have to document that, right? So I think it is fair play. I think it's interesting. I think it's actually a good program that they're giving guidance instead of just giving a generic, yeah, your loan hasn't been approved. I do think it is a good thing for the industry.
Rob, you look like you're chomping at the bit over there. What do you want to say on this?
I mean, it's, I think part of the reasons why the models turn more black box is because there's so many different calculations that are layered risk type of calculations and cash flows that go into all these different credit parameters. So it's not always easy to say that moving one variable is going to change the final decision because of the way these different credit components are evaluated and figure into these cash flow models. And so I think that's why it's gone black box, but I think to the extent that there's different ways to expose those calculators to lenders so that they can, have candid feedback to borrowers on here's what it would take to become approved. And I don't think it's gaming any system at all. I think it's the agencies put together their credit models on purpose with their data. And, when you reach a certain threshold, they're going to approve it. And if you can expose that calculator to lenders to help them figure out and guide borrowers on where, what parameters they need to get that approval, I think that's fair game. And I think that's productive to the industry. So that's, I guess that would be kind of my perspective on it. And the more transparency, I think, writ large in the industry is good for the industry as well.
Marcus, I'll give you an open floor to talk about what you want to talk about, but I would like you to consider how this plays into the future of AI in the industry. I'm not sure if you had any notes on that.
Well, let me start by saying I agree with what Ira and Rob said. I also think what Freddie is doing is they're just saying the quiet part out loud. Because if you think about what underwriters and processors do, if they get a caution, they're basically reworking the data anyway, and then relaying. So they're increasing income, increasing assets, maybe lowering LTV, just to relay that information back to LO and saying, okay, well, here's your findings. Here's what needs to happen to get an approved. I think this is just making that crystal clear now. I think what'll be interesting to see on the AI front is if it gets into the weeds of maybe specifically what type of assets they were looking for. Maybe it's retirement, maybe it's equity, maybe it's, I don't know, something. And I think with AI in the future, I think it can get really creative and maybe overkill in terms of like, what do you call it? Machine learning, where you take different characteristics and start correlating all sorts of stuff together. I don't know where this is headed, but as in the Freddie Mac's AUS, but I can see it getting really, really granular on specifics of what it's looking for.
And Ira, I'll let you elaborate on AI since you brought it up originally. But a good question from Lorene in the chat, and maybe our attendees uh, know the answer more so than some of us up here on screen. But does anyone know if Fannie's working on a similar enhancement to DU? And I'll add the added caveat there. Normally, it's Fannie comes out with something first, and then Freddie kind of follows in their wake. It's like Freddie took the initiative here, which is neat to see. But Ira, first, heard anything from Fannie, and then if not, any comments on the AI future here?
Yeah, I haven't heard anything from Fannie. I didn't even hear this coming from Freddie. It sort of just popped up in a regular release email, and I just haven't heard anyone talking about it. And in regards to the AI, I tend to agree with Marcus on his points. I think we could see things start to get really, really granular, where it sort of, things that the wrench is in, and not to get too in the weeds because this could be a whole different topic, but I believe there is a law in maybe California in regards to AI and, requiring a, sort of a request for a manual underwrite, that if an automated system was to not receive an approval, a borrower could request that that loan is a manual underwrite. One of the states has, and I don't know the exact specifics of it, but I think that could also sort of throw a wrench into that whole thing. Where does that sort of stop? So
Mike
those are
in the
my
chat
thoughts.
said Colorado. California has too many laws. I just had to ship a bunch of bathroom like shower heads to Nevada for a remodel I'm doing in California because they limit the water flow. It's a whole thing. But yes, Mike, thank you very much in the chat. Colorado Senate Bill 24-205. So maybe we could look into that. Rob, before we move on to the next subject, kind of I wanted you on this show to be the professor here. And I mentioned something where it's normally Fannie leads the way and then Freddie follows. This case, Freddie's leading the way. Why has it been that Fannie normally leads the way, or what's the interplay between those two in terms of one making a decree and the other one saying, "Oh, well, let's see how it goes, then we'll follow it, or we'll do our own thing"?
I think they both have a very talented bench of professionals, and they compete vigorously against each other. There's different people that move back and forth between the companies. So I think it's a fun competition, and I think Fannie's going to have some wins and Freddie's going to have some wins, but I think they're out there competing to do the best by the American borrowers. And this is, I think I would agree with your point. Great for Freddie for getting this out, and it's another area and just what the agency can do to the marketplace. And I applaud it. Keep Fannie on their toes.
Yes. Well, since we've spent a lot of today's call talking about government, I guess we'll keep going here because we just had Hurricane Helene. We have Hurricane Milton bearing down on Florida. It looks like it's going to swipe across. I think it just dipped below a Category 5 rating back to a Category 4, but it's only a couple miles an hour away from going back to Category 5. Regardless, the storm surge is predicted to be massive in the Tampa area. Ira, I'm hoping you can provide some color on the impact on business. I know you're up in New York. When Hurricane Sandy hit, it was very beneficial to have branches in other places and be able to keep business going. But your thoughts on disasters and companies' abilities to close loans as a result?
Yeah, I think it's, diversifying your footprint can definitely help, especially as we hear more and more disasters, whether it's floods, winter storms, hurricanes, fires. If you're located in an area that's prone to these disasters and you're only in that footprint, I mean, one storm and that could shut you down for a few months. And that's assuming that there's no real damage to the properties. You have to get re-inspections for every loan you close. You have to make sure the property is still standing. Could be possible insurance issues, let alone your home office still, having power to even close loans and your employees. So as you mentioned, when Superstorm Sandy hit, we're located, home offices on Long Island in New York. So obviously a lot of damage in multiple states in the Northeast, and having the, other branches in other areas of the country, it could be a huge difference. You could still close loans in those other states. If you're a month or two, sort of handcuffed from closing any loans just because you're located in one specific area, that's a major hit to that bottom line, especially nowadays, coming off the last 2 years of reduced volume.
Yeah, it's almost like we can bifurcate here a little bit. There's what's going to happen with borrowers, and there's what's going to happen with our actual branches, and you need to accommodate for both of those. Rob, I'm wondering if you're running a secondary department and you have a big book of business in Florida, and it seems like we've had a whole hurricane season packed into 2 weeks here, and we still have another couple months of hurricane season. What are the best practices for a capital markets department, knowing there's these disasters that are happened, could still happen in the coming weeks or months?
Well, I mean, it's and I think Florida lenders have unfortunately had a lot of practice with a lot of these things, but I mean, you don't know when what's going to hit, right? And so I think certainly first thing you need to do is assess and triage when you actually have an event hit. And, there's certainly both pipeline implications that Ira mentioned, just like the loans in your pipeline right now, some of the investors may be backing out. As I mentioned, there might be re-inspections, closing issues, even with being able to close, insurance. So you have the immediate assessment of just being on top of your existing pipeline right now and trying to assess where the impact is. And, and this is, of course, figuring out what you can do to help your community, because, many of these lenders are out there trying to figure out how they can help the community, period. So these are initiatives that are going on, in parallel. And then there's the servicing piece as well, right? Which is, so if you're a servicer, there's, the longer lasting impact of these events. And from the lender servicer's perspective, if you've got Ginnie servicing or scheduled Fannie Freddie servicing, there's the potential of forbearance. There's a potential of having to advance payments and taxes and insurance for periods of time. So then from a secondary point of view, extending into servicing, it's like preparing for where these advances, the balance is going to come from, and what is that going to do to the overall health of the firm.
Well, it sounds like people can learn more about that at Panoramic Capital. You talk about servicing value and stuff. Marcus, where's your head go for a secondary marketing department dealing with natural disasters? I mean, we're out here in California where there's wildfires, there's potential earthquakes. It's something that seems like it's becoming, well, I won't necessarily say more prevalent. The amount of monetary impact is becoming more and more and more. And so it's not something that people can turn a blind eye to, even if they might have their own reservations about, is the climate changing? But in terms of dealing with these natural disasters and the impact on closing loans, what's some of your advice?
I think it's just staying proactive. I mean, to your point, in California, it didn't rain for what feels like an entire decade. And it definitely felt like there were entire months where the sky was completely orange just because there were fires in Napa that were raging through the state. Staying on top of investor announcements, programming CRA or MSA or census tract IDs into your pricing engine as, triggers of, hey, if you land in this address, maybe you shouldn't lock your loan or build rules around that. And, back when I was at Opus, we were primarily California, Oregon, Washington. And when there were fires, assuming it was safe, we would at least ask the LO, like, can you drive by the property, see if it's still standing? Because to Ira's point, I mean, post inspections could take some time, especially when there's a lot going on. So just being able to control what you can control is what I would say.
Well, I did tell you as we were setting up the show, I needed you for comedic relief here a little bit. And obviously hurricane damage isn't something that's funny, but in terms of people that are saying, anytime in the daily newsletter we bring up some climate catastrophe, it's, oh, we're on this left-leaning bias. And it's like, hey, if investors are going to be pricing things a certain way where it's going to be impacting the industry, who cares if you believe in climate change or not, right? It is impacting you one way or another. Your thoughts there? I'm sorry to put you on the spot.
Yeah, I would agree that the data is the data, and you can interpret however you want to interpret it. But if you are going to price for disaster, you should. I mean, insurance companies already do that with homeowners insurance and vehicle insurance as well, right? If something's more prone to breaking down, they're going to charge more.
There's some really cool data that's come out uh, from some of these insurance companies where they're actually insuring, you know, condos on different levels of a complex in different ways because of the propensity for disasters to impact them, and they're getting down to very granular levels. Maybe that's just a theme in general of the way that, you know, pricing is moving forward. Granularity is becoming so sophisticated, whether it's insurance stuff or borrower profiles or whatever it might be.
Well, I think that's where AI and machine learning comes from. I think that's where it's going to take a big stance. I mean, not mortgage related, but I just saw something like Geico dropped all insurance coverage on specifically the Tesla Cybertruck. I bet you will see something similar to that, maybe with like condos on the second floor in certain regions have certain different analytics behind it.
Yes. Well, let's go from something that's a little dour to something that's optimistic here, and that's kind of the general mood in the industry. Is, hey, the Fed did a supersized cut. Even before that, you know, September employment, the labor market isn't crashing. We don't seem like we're headed for a recession here. Rob, I'll start with you. Kind of the general mood. There's a general mood of optimism out there. Hey, mortgage originations are going to be coming back next year. We're not going to get a refi wave like we did in 2020 or 2021, but refis are coming back. The purchase market is coming back. We could see rates, you know, dipping below 6%. There, it seems like the worst is behind us, and people are excited about what lies ahead in mortgage. You sensing that too?
I certainly sense the optimism, and after being beaten down for a period of time, I think everything tends to want to be optimistic. I think it's from a risk manager's perspective. Our mantra is always the same, which is the perfect pricing theory, that rates are pricing in the perfect expectations, and anyone assuming that rates are going to drop, you're going to possibly let counterproductive measures enter into their what they're doing. And so yes, I think there's optimism in the industry, but it's I think you have to exercise vigilance and not thinking where the market's going and acting upon that.
And I do want you to bring up your slide on recapture here in a minute, but I'll go to Marcus. And Marcus, I want to ask you very qualitatively here. It seems like this eternal hope that Rob talks about, it's there for better or worse. At the start of the year, it was, oh, the Fed's going to cut rates 8 times, 7 or 8 times. And even going back further, it was the market had gotten ahead of the Fed and was predicting a much more dovish Fed than what we've actually seen. Is this benefit mortgage capital markets for hope to spring eternal? Is it to the market's own detriment? What can you explain the relation between kind of the streets optimism and what's actually going on in terms of originations and those sorts of things?
Yeah, well, I think for the eternal hope, when you're at rock bottom, there's nowhere to go but up. So maybe that's what's going on more so than the Fed's going to cut another 50 by end of year. And there's a lot that can happen by it. I think what the projection for next year was in the 2-something range for the Fed funds rate, but a lot can happen, right? You have an election, you've got escalating global conflict, inflation could tick back up. We just saw a strong employment report. The Fed could have a crash landing versus a soft landing. There's a lot of uncertainty. I think there continues to be a lot of uncertainty. From my point of view, what's that like really inspirational quote? Something like, luck is when preparation meets opportunity. I think lenders should focus on that. Just shore up your tech, shore up your staff, shore up your business model, and with plan for the worst, hope for the best mentality. I don't know.
Yeah, Ira, you had said, we're kind of in this hope phase of, rates are going to go down from here, rates are going to go down from here. But like Rob said, in theory, all this has already been priced into the market. And no, we haven't priced in a proliferation and conflict between Israel and all its adversaries in the Middle East. We haven't necessarily priced in a U.S. labor market that might continue to slow, even though it seems like it's not. So I'd love for you to elaborate a little bit on this thinking that rates are going to keep improving when it's already in theory been priced in.
Yeah, and I think that's the mistake, a lot of salespeople make, a lot of, industry people make is trying to sort of guess what will happen with rates. Marcus put it perfectly, you could prepare, shore up your processes, your tech, but we can only sort of deal with what we're handed, right? We're not going to figure out what rates are going to do. The Fed's repeated that it's data dependent, specifically the employment situation right now. And so, all it takes is one report like we just had last week for rates to pop back up by 35 basis points. So, you can't sort of, it's not a gamble, right? Obviously running secondary, you're not trying to figure out what's going to happen with rates, and you start to you start to really get into trouble if you're trying to sort of bet on what will happen. Any of these changes have already been priced in, as you said. The market's trading trillions of dollars every second of the day. And for anyone that thinks that they're gonna sort of pinpoint what's going to happen when there's that much money being traded around, it's sort of silly. So I think it's just, cautious optimism. I think the last week, has been a little bit of a thorn. I think that was that sort of spike was a little bit unexpected. But you just have to prepare for those events and that volatility, and that's all you could really do right now.
Well, it's always a reminder that nobody in this industry has a crystal ball, even if they purport to. And Rob, I don't want to make it too rudimentary, but one of the things that I learned early on when I was working in capital markets departments was it shouldn't matter where rates go. A good capital markets person doesn't care where rates go. They're properly hedged and they've mitigated their risk. Can you agree with me here? No, we've gone beyond that need.
No, the job of secondary, is to preserve the profit margin, right? The lenders, like any other business, it needs a certain margin for a number of widgets to turn a good return on equity. And so it's secondary's job to preserve that margin. And there's, a lot of things that go into that. Tech, knowledge, smart rate sheet pricing, and smart lock policies. And yet, with those things lined up, that proper prep that both Marcus and Ira spoke about, then you can preserve that profit margin. And to that end, then it should be less relevant what happens to the market. And there's certain things, market volatility, that can frustrate that a little bit, but still the job of secondary isn't to call that market.
True. The one space, and Marcus, I'd love if you could comment on this before we go to Rob's recapture, is servicing values. We're going to see a large movement in servicing values as rates go up or down, and that's constantly changing. And so, Marcus, there's been talk by less intelligent people than we have up here today about this refi boom that's going to happen. And I would remind listeners that such a small percentage of the universe has rates, even if rates drop below 6%, there's such a small percentage of the overall UMBS universe that actually is in the green for refinancing. Thoughts on this refi bump? Thoughts on, where are we with that? What are you hearing? Stories on the street?
Yeah, I think it's more of a bump than a boom. I mean, I'm personally sitting on a 2% 15-year fix. That's not going anywhere anytime soon. I'll hold that on to 30 years if I can. I would say in terms of the refi cycle itself, I mean, I don't know what to say there other than, as I said earlier, like shore up on your tech, right? Get rate alerts in your system, use rate monitoring services, do batch API for your pipeline, just to really check what you have that's refi eligible. Because you're right, like if the bulk of your servicing is sitting at under 4%, there's really nothing to do there, at least anytime soon.
Yeah, Rob, you had made it sound like before we hopped on this call that we're actually seeing recapture assumptions are finding their way into MSR values. I'm hoping you can elaborate on that a little bit and maybe provide some of the academic explanation behind it.
Yeah. So, I mean, there's always in the industry the retained release decision that lenders make. And, it starts with, do I even become approved to service? which is a big conversation and a lot of prep and capital. And then once they're approved of service, then do they have best execution set up to where they can either retain or release? And increasingly, some of the larger shops have started to be a little bit more proactive and specific about how to anticipate being able to recapture a loan if it's going to pay off, right? And it's like IMBs know that when they have their investor relationship or the investor agreements negotiated, that there's this possibility that the investor is going to say, we want recapture or we'll share recapture with you. And depending upon how good that investor is in that actual recapture process, that's going to guide the IMB into saying whether they want to release that loan to that investor or not, right? Because the IMB has their loan officers that they'd like to help retain that future business from their relationship. And so there's a lot of conversations, and lately we've heard different investors out there that are paying what seem to be very strong multiples for servicing, and with a lot of what we have to do in secondaries, we're inferring where are these economics coming from. And so that and that's the whole conversation behind recapture has to be seeping into the valuation of servicing based on some of the bids that IMBs have been seeing.
Ira, can you talk to us a little bit about your own retain release decision making as we've seen rates start to trickle down here, and what's going on in some of those higher level conversations you're having?
Yeah, so sort of just like Rob mentioned, we have an internal metric on the decision whether to retain or sell that servicing released. It's the values that the investors have been passing along have been pretty aggressive. So internally, as a mid-sized IMB, we've been retaining a little less than previously. We do understand that obviously they're paying up for that business. They're going to want to recapture that business, and they're going to be aggressive in recapturing that business. But it's still really hard to give up that initial cash to sort of hold on to that loan for hopefully a while. If we do see rates drop, obviously, then we're going to have to sort of recapture our own business. So that net, does that really work out to make sense? So we're definitely selling more to the aggregators versus retaining internally.
Since we're into the dying embers of the show here, Marcus, I'm going to give you the last word on thoughts on recapture, retain release, what you're seeing with servicing values. Is Stan Middleman pounding his fist on the table now? What's going on here? Talk to us.
Well, so my previous role was heavily in the IMB space as well. I'll just say that from the IMB seat, cash is king. And if someone's willing to pay through your servicing multiple, just give it to them and figure out what to do about recapture later. I mean, I think we've always said servicing's return of capital before it's return on capital. And if someone's willing to pay you that upfront, just take it.
Very good point. Well, I want to thank everybody for tuning in to today's show. This is certainly a very well-attended show. So thank you to everybody that joined. Thank you to our panelists. I'd like to say that next month, Rob Chrisman will be back. I don't control his travel schedule, though. So fingers crossed that he will be, although I do enjoy spending time with you all. And a big thank you to Pauly, as always, for sponsoring Capital Markets Wrap. I would encourage all you to head over to pauly.io, check out their website, check out some of the cool new things they're doing when it comes to capital markets and the tech stack there. We will see everybody on the second Tuesday of next month in November. That'll be right after the election. So we'll have some juicy things to talk about with what the election outcome or contested election outcome could mean. But guys, thank you very much for joining me today.
Thanks, everyone.
Thank you so much.